Hello, Jay. Hello, Terry. How are you guys doing?
Doing good, Sherry. How about yourself?
Good. There's a lot of topics we would like to discuss today with you guys, as we didn't do it last week. So since last week, the market has been very volatile, as we could see from the daily VIX chart, and it's all originated from the yen carry trade and also the impact on the leverage. So would you guys like to go in deep into what causes market volatility and whether the yen carry trade has been unwind for now?
I guess I can take this first. I know you've got a lot of thoughts on this, Jay, so I'll be quick. Yen carry trade's been around for a long time. Basically, just so people understand what they're dealing with, for forever, the yen has been the most dependable way to borrow to build leverage for other asset class investments, because it's not only generally a weak currency and generally has the lowest rates, but it also has the least amount of risk for central bank tightening in Japan. And that's we're going back 2-3 decades here. So it's become a structural theme. And right now is this really odd period where suddenly the US is thinking about cutting at the same time as the Bank of Japan has started a tightening campaign. And that struck this unwinding. And the way it really works is basically if you borrowed a lot of yen to build leverage for investments in other instruments, as soon as the yen starts to strengthen against something like the dollar, which is the predominant carry right now, you got the sort of double pinch. You got the pinch of the fact that the yen that you borrowed, you carry that debt. And as the yen strengthens against the dollar, that debt grows, right? You owe more and more because the yen, it takes more dollars to buy the same amount of yen if you're going to repay that debt. So as this moves higher, you get a squeeze effect, really, because everybody's competing to deleverage and to make sure they don't put themselves into a wipeout position. And we saw that last Monday, and it was a big factor involved in the sort of crash that we started with last week. Jay?
It was all kicked off, of course, by the Bank of Japan. All eyes were on the Fed on Wednesday, and not as many people were focused on the Bank of Japan on Thursday. Bank of Japan was expected to strike a hawkish tone, but they weren't necessarily expected to raise rates. So when they made that move, which would have been August 1st, that Thursday, that set off the chain of events that Terry's talking about here, where number one, the Bank of Japan had been expected to raise rates for a few months, but they kept dragging their heels, and I think a lot of investors were expecting that to continue. That's why that rate hike caught so many people off guard, and that really set into motion that carry trade unwind. Of course, we came in Monday on August 5th to Japanese down 12%, just a massive decline there from that unwind and the surprise rate hike that started catching up to over the weekend. And that naturally led off things here in the U.S., leading to that steep decline in the U.S. as more and more leverage was taken out, because that's the whole point behind a carry trade, to leverage yourself up to such a degree that you can maximize your profits. Of course, when that unwind comes, that also amplifies itself in the other direction. Now, the other impact that it had there was on that VIX trade, where you have a lot of people short just because things tend to run pretty quiet. We've seen that short volatility trade really dominate the last couple of years. There's times where it's unwound. In 2018, you had Volmageddon was another unwind of that VIX trade. So what you have there is you have the VIX starting to increase, and you have people chasing that VIX and paying more and more insurance to cover themselves to the downside. When you don't have people off sides like we saw, that means a big influx into it. That's why you saw the VIX up to its third highest level since 30 years, I think it was. The only other times you had the VIX higher would have been during the COVID and the financial crisis. So, it just, and if you think about it, there wasn't anything out that was that bad. You could look at the jobs numbers, which were a little weaker, which helped amplify that trade on the idea to what Terry was talking about, the U.S. cutting, and just all those factors really worked its way into a perfect storm of volatility being increasing, short volatility positions getting squeezed, and carry trade holders forced to unwind. And that's why you saw that big drop. So it was really much more of a structural move in the markets than any one data point necessarily or any one major concern. Terry, you got something to add to that?
Yeah, I'd like to say that, yeah, so perfect summary there. And I'd like to say that we learned two positive things through that process that markets are digesting now. And one is you have kind of a central bank put, and we know that's going to be active. And the place that it would be hardest to see is Japan, because they haven't really had a hiking cycle, and every other central bank has a ton of ammo to threaten. Well, we're going to allow market instability to creep into our economic models, which means, we're ready with ammunition, liquidity to do whatever is necessary to maintain things like that. That messaging is sort of looming out there and can start anytime. But the one place where they didn't have as much ammunition was the first to do it, with the Bank of Japan coming out basically the next day and saying that, they like if markets were unstable. So right there is basically their version of a central bank put. And really basically was the answer to this dive so far. And the other thing is, we tend to get bear markets when you see the market dive and the VIX does not respond. I mean, that's really kind of almost a law of market movement, that you rarely get a real bear market that isn't just a flash crash of some kind, but a steady distribution over time that's significant in terms of prices. You rarely get that starting with a big VIX spike. Usually you have about a month or two of all the pundits on financial news saying, oh, the VIX seems to be broken. The market's down 12% from its highs and the VIX is still at 18. What's going on? Like, that's a red flag when you hear that. And in this case, days into a correction and the VIX is at 60. That is not consistent with a steady downward trend. So that's a bullish signal. And the way that central banks reacted was a bullish signal as well.
Yeah, and I with everything that Terry had to say there. Been seeing reports. There's really no way of measuring how much of the unwind trade was taken off. There had been reports from Morgan Stanley that 3/4 of the trade had been taken off. I don't think you need to worry so much about getting caught up in the actual logistics of that, as much as to understand that a significant amount of leverage that had been in the markets that had inflated things were there.
Evaporated.
Now we're certainly seeing elements of the dip crowd coming in, and this was something that Terry had talked about in our last meeting, where there's a whole slew of money out there that over the last 5 years have been those who have been buying dips, and they kind of buy the dips, and I think you're
they own all the money. They have
they've got the money. They've been smart enough not to chase and awaiting for a pullback on things. So, one of the things at the beginning of this whole sell-off was a lot of people were talking about Warren Buffett and Berkshire Hathaway and how they hadn't put any money to work and that they'd been sitting on that massive cash pile. I guarantee when we come back in Q3 earnings that Berkshire's put some of that money to work, and you'll start seeing that play out, which leads me to just my next point. We will be getting 13 Fs from hedge funds over the next couple of days. Be very careful in trying to read too deeply into those 13 Fs. Recall, this is all going to be data that expired on June 30th, and it's not going to be reflective of any actions taken over the next couple of days. So when you're looking at who's holding the money now, who's in the markets, just kind of remember the 13F. And remember that a lot of that leverage that had driven away the valuation from some people had been taken out. And you're certainly seeing some elements of that coming back into play.
Absolutely.
Got it. And previously I saw Warren Buffett also get the cheap Japanese yen in Japan and bought some corporate debt and invest in Japanese market. Do you guys think like Warren Buffett also like participate this time? Like I saw him keep selling Apple stock and also Bank of America stock. And does that also have to do with the yen carry trade? Just curious.
I mean, personally, Apple just become too big of a holding because of its appreciation.
Yeah.
Yeah, I would agree. I don't imagine that Warren Buffett is one that partakes in the carry trade too much. So
he's cash. He doesn't need the leverage.
Yeah, exactly.
I see. Yeah. So, and not would like to discuss with you guys is one of the article you write yesterday that nowadays fund manager are more cautious about the recession odds, given like current data. So I see that tomorrow will be retail data and earnings from the big retail like Walmart. So what do you guys think will the market going for the next like till the end of August?
I get that one first. Okay. So quick. So yeah, I do that. There's certainly a focus on the potential for recessionary data. We jobs number that shook things up a little bit there. Now, inflation data has been a positive the past couple of days. You had the New York Fed consumer survey on Monday, PPI yesterday, CPI this morning, all providing tailwinds for the markets. However, took a look at the Bank of America Fund Manager survey and just kind of looked at the three things that were the biggest concerns for them. And I know, Terry, we talk about this, and this survey would certainly be from a weighting in terms of how much people think about it. But number one was recession. Number two, geopolitical concerns. Number three, inflation. And I don't know, Sherry, are you able to pull up a intraday chart of the S&P today?
Yes, here, SPY.
Yeah, that we can on a 5-minute chart. Something else that today's price action. Yeah,
5-minute chart. Would this work?
You can expand it just a little bit more. Basically, what I'm trying to show here is right at 10:30, that big red bar down. Just expand it. That big red bar down right at 10:30. Yeah.
Yes.
So that was a response to a build in the inventories, which would suggest economic activity. Now, what I'm closely here is to see how we respond. We obviously saw a positive response to the inflation data, but what happens if claims tomorrow comes in a little bit cooler? What happens if retail sales misses expectations? What happens if industrial production falls flat? I want to see how the market's going to react to that, because as we saw the fund managers survey, recession fears are starting to overtake some of the worries about inflation. So while inflation is certainly positive, trending in the right direction, the Fed's already said on a couple of occasions that they're a little bit more seeing a bit more balance of risk. And that's why I'm real curious to see what the market's going to do if we get a weak round of harder economic data and how they respond to that. Terry, I don't know if you got a thought on this.
Yeah, no, exactly. I mean, I'm in this position as what I see in this survey, which I don't always love, but I can't, this Bank of America Fund Manager survey it matches my views. I think that we're 200 basis points above our star right now, and we've got the inflation situation, pretty much settled. As far as I can tell. I mean, when you look 3-month rolling core PCE, if you hit 2%, and that's probably the most important data point in terms of measuring inflation, and that's the one that the Fed looks at the most, and it's at 2%. And I mean, the balance of probabilities, the risk is they've gotten us saying risks are balanced, but I mean, at this point, it's far more of a risk that they stay too high too long, and you can't stay as restrictive as 200 basis points above our star and expect things to just kind of cruise along. Your dominoes falling. And one of the metaphors that I always kind of think about first is if you imagine a race car on a mud track, like you have to turning the wheel way before the track starts to curve. If you're mud track kind of off-road sort of race. Like you've got to start that wheel midway up the straightaway to hit the turn. And if you wait until you see the track curbing and then start to turn the wheel, you're going to go slamming into the wall and crash. And that's why it's hard to hit a soft landing, is they've got to be anticipating. They've got to be moving with the neutral rate when they don't have an emergency inflation situation. They've still got rates set at an emergency level. And it's not necessary now, and it's not conducive to a soft landing. And I think that's why we're seeing fund managers start to, I think we saw one of the charts of the Bank of America survey was like something like 65% of fund managers see monetary policy is too tight, and that's the most since I think 2008. Yeah, and they can see on the ground what's going on, and the Fed is a little detached, I think, and a little kind of. And I wonder, we're going to talk about this a little bit more, but I wonder if there's in an election year, in a situation where one of the candidates has overtly proclaimed that he thinks the Fed is too independent, if they're really not looking biased and they're hoping to put off their cuts as much as possible. And I think that we're starting to see some bets in the Fed funds futures to that effect.
Yeah, and to Terry's point, I also read an article said there's a risk of a recession from the private sector perspective. Of first is Airbnb sees soft demand on overall consumer weakness, and also rise of unemployment from 4.1% to 4.3% in 1 month. So maybe we also need to pay attention to tomorrow's unemployment report to keep update. Yeah, as a
claims.
On
You mean the jobless claims?
Jobless claims.
Yeah.
Yes, Fed has dual mandate of inflation as well as the job market. Maybe that also shows us the strength of the economy.
Yeah, if coming in higher than expected, a miss on sales, a drop off on industrial production, and we've got two, Philly Fed and Empire, both viewed forward looking, and something that I've talked about for years, where sentiment data just tends to run a little bit more negative than hard data. So you do have potential for a perfect storm for those recession fears to start cropping up, and all this is going to come ahead of Jackson Hole next week, of course. So should make for an interesting 24 hours of data.
But with one last point, I will say, generally speaking, jobs data is either coincident or lagging in a situation like this. Like if ending on the way, it's going to set itself up in an inevitable sense before you start to see it show up in the labor market historically.
I see. And look at the chart. So if we look at the daily chart, like from last to second, from the pure stock market has been rebound significantly, like more than 20%. I think later this trend continue, or we would have more correction.
I'll start this one. You can take the ball after that, Jay. So going back to June, I think Jay and I were both kind of on the way, coming into a period seasonally weak is the year where it makes sense to be looking for a lateral consolidation period. And I think we've seen the first major swing of that's defined a range zone. And I would say, for me, from a technical basis, you can see the trend line, the depth that's about to be tested here. If you just connect those first two highs and extend it across, you can see that there's my experience, that overshoot through that trend line and then correct back into the middle of that range. And we're going to get a congestion period. I mean, that's how this is a base case from a technical analysis standpoint. So you've got a kind of congestion zone already building with that June range leading to that late July range, now leading to where this overshoot of this trend line is, just right in the cluster. We're kind of in the mid right now. And that's be difficult to just blast right through there. I would say this is a period where, we're going to build till the latter half of October in a consolidative kind of mode. And then if this is something where people become malpositioned once again on the bear side in a continuing bull market, and the Fed is ready to really react and try to turn the wheel ahead of the curve as hard as it can, maybe right after the election, and that's kind of some of the signaling that we get. then you get this late October into the election, through the election, you get past the uncertainty of who it is. It really doesn't matter for the market probably, that you get uncertainty of it. And to the certainty of a 50 basis points cut, if things have held together until then, and you get to the seasonally strongest period of the year, November and December, that's when you look for the new highs.
Got it. So probably an investor would wait a little bit to see like end of September to see whether we can have more attractive entry point, and then.
Well, yeah. So let me add, you've got this situation in place, right? The Fed has a ton of ammo. We haven't seen this since 2006. This kind of ammo, right? Like this is they're going to be afraid of any messaging from the Fed that basically comes to something along the hints that we've heard over the years of, the Fed's provide liquidity if markets become unstable, anything like that. Now, 200 basis points above R-star, that means a lot. Like they could come out with, just throw out basis points emergency cut for no reason, because they'll still be above R-star. They'll still be above neutral. They'll still be restrictive. With inflation already at 2% on core PCE 3-month annualized, they can do that. No problem. So nobody's going to doubt them when they come out and say something like that. So that on any kind of downside pressure, that's there. That threat is just implicit all the time. It's going to make it really difficult for the market to fall apart, to know that kind of safety sitting underneath everything. And, that's during a seasonally weak period can just build a sideways consolidation.
Got it. And so Harry and Jay, would you guys think, so based on the current data, there's more chances that the Fed will cut 50 basis point in November than in September?
I think big speech Powell is going to kind of help people define that we get 25 or 50 basis points. Now, we've got the econ data that we talked about. We still got P numbers to come at the end of the month. We got another round of jobs and CPI data. So my assumption is Powell is going to talk about that they're ready to move forward with the rate cut cycle. He might even say the next meeting. And then that's going to kick off the debate of 25 or 50. And that is going to be determined because he's still going to talk about how they're data dependent. He's just going to note that the data is running into a spot where they feel that they can move off from their restrictive stance. So they're going to rate cut cycle. I think they want to be sure that they can do a couple of rate cuts before. They don't want to make it seem like they're just tweaking at 25 here and ready to tweak it 25 back. If they don't want to get caught in a situation where they look like they're playing around with things too much, because don't forget, it takes about 6 months for these rate cuts to really start taking impact on the broader market. So I think next week Powell's going to hint that they're ready to start moving forward, perhaps at the next meeting, and then it's going to be a debate around 25 or 50, which people will be leaning heavily on that econ data when it comes out. And then, as far as those, we got a data to come. We got a whole Q3 earnings season that's going to be released in that time frame. So, I don't too far out into November. The CME Fed futures haven't been accurate on that. So, I really all speculation at this point on that. So my assumption is that we see him go 25 in September at the moment, and then be prepared to do another 50 in November. That's how I'm kind of seeing things play out. Terry, what's your thoughts on that?
I agree wholeheartedly. But I do think that if there was an emergency right now, they'd be cutting more aggressively. And I think that we moved past the feeling that there's an emergency right now. And I think could oddly become the problem, because it's awfully tough, I think, for the Fed to make a big interest rate move 2 months before a presidential election, when there is already a kind of narrative out there in some circles that the Fed is, operating with bias politically. And trying that narrative and then using that as a tool to undermine the independence of the Fed. Like, it's tough if you're at it right now. It's easy to say, you know what, there's not an emergency right now. Let's do 25 basis points. We want to cut more. We probably should cut more. But, we can right after the election. And if we cut 50 basis points there, it's still 75 basis points between now and then. It's the same amount, And as long as we're not, nosediving economy at that point, we're sort of there. And I think that that's probably an all too easy kind of perspective to adopt right now. And I think sitting 200 basis points above neutral, that's a lot of time that can go by. That's a lot of stuff that can start to go wrong under the surface. And, to not adjust that more aggressively. As I said to you in a conversation we had outside of this podcast, I think that's on a 75 basis points emergency cut and then 50 more at September. I think they need to get back to neutral fast and then let the dust settle and see where we're at. They've already bent the curve on inflation. Inflation's taken care of as far as this cycle. It really was transitory. It really was reopening. And I think at this point, you're just playing with fire, keeping it way, way, way above neutral. So, I think it's too easy to kind of fall into that feeling like you're kind of managing public and doing your job at monetary policy.
See, so here's my issue with emergency. But just kind of through and look at some of the other emergency rate cuts that have been out, right? So most recently, they did one back in March of 2020 and then May of 2020, obviously around COVID. Prior to that, you go to the great financial crisis in 2008 when they had an emergency 50 basis point cut on October 8th, which would have been shortly after Lehman, right? Then before that, January 22nd of 2008, that's when the housing bubble first started showing some real signs of breaking out. So they're the last four done. Now, prior to that, you go back to 9/11 when they did one on September 17th of 2001. Then you get into the first time you would have seen an emergency cut of 50 basis points trying to preempt some economic weakness. And that would have been in April of 2001, which would have been the bubble burst of the internet bubble.
Mm-hmm.
Right?
Remember, I was short down to that.
Yeah, so it's been a long time since now you could say AI is in a bit of a bubble. If we see that that could be something that would be reflective, but I think it's very difficult, especially optics, for them to go in and do an emergency cut, especially when we're not really seeing data all that bad. 4.3% on the unemployment data, that's historic lows. So there's really it to the idea that, okay, the Fed's going right back to a playbook, and that's the first signs of a recession. Immediately just go crazy and throw as much at it as you can because you want to forever avoid a recession for the rest of your life. Don't worry about monetary policy. Don't worry about debt levels. Just continue to keep feeding the market. So I'm not in the camp. We need an emergency cut here at the moment. I think that the Fed will start a cut cycle that will see them move at least 3 times this year and about 5 times going into next year. There's been a big debate on star rests, and I don't think that anybody really has a great answer on that. So I just don't think you could use R-star as a primary reason for the rate cut when they have never been able to definitively tell us where it is. Outside of that, it used to be at 2.5, and now they think it's somewhat higher than that. So I don't think we're going to see an emergency cut for those reasons.
I don't think we are either. I never said I did. And I think that everybody is absolutely in agreement that R-star is not 5.5%. So we're well above R-star, whatever it's 4.25, maybe it's 3 3/4, maybe it's 3%, maybe it's 2.5. Who knows? But it's nowhere near where we are. And if we've already got 3-month annualized core PCE at 2%, you're going to run into the wall. And we haven't seen the emergency economic data. By the time we do, it will be too late. If you're well above R-star, if you're well above neutral, if you're in restrictive territory and we start to see that, there's no doubt you're going to see a serious kind of, correction in the economy. There's no way you're going to see that data first and then cut rates and prevent a recession. If they're going to navigate this to a soft landing, they would need to be proactive. I don't think they will be. That's not in their DNA. And I think you're right as far as how they will behave. I'm just saying what I think if I was managing, like if this was sim life and there's sim fed, I'm playing that video game, that's what I would do. And I understand, yeah, historically it's tough to do it because there's all sorts of factors other than what would be the best choice. You've got to manage expectations, you've got to manage credibility, you've got to manage all the elements of public perception, and really you'd have to be really terrific at things. And those things are not necessarily the case.
Add in one thing too in terms of communications. We've had two Fed speakers this week, but I do want to put a caveat by them. One's Bostic, the other one's been Bowman. Both of them talked a lot about quite being where they want it to be, and that they wanted to avoid cutting rates and then raising rates back up. To be clear, these are viewed as two of the most hawkish members of the Fed. So I would be careful just trying to over message that we've gotten from them. And again, there's going to be a lot of Fed speakers next week, obviously Powell on Friday. So just be a little bit careful of, reading too much into what's been said, say, to our audience.
Got it. And as Fed is going to cut rate in September, November. So my last question would be that to looking at the stocks that will benefit from rate cuts, something like IWM or the high dividend stock. Do you guys think it's a good time to entry those like Fed cuts benefit stocks?
I think that is if we do get this 25 cut in September, then I think that when you get to the seasonally strong period, October, post-election to the end of the year, I think maybe you start to move it to a little bit of a disproportionate allocation to small caps, biotechs, REITs, even regional banks, maybe long duration technology like the style stocks like that. That's the same thing that outperformed at the end of last year when the Fed made its initial pivot, when we had that November 1st communique and November 1st communique from the Treasury, November 3rd Fed meeting, I think it was, and then this stuff just exploded into year end. Jay, you remember that?
Yeah, no, I agree. I guess the only thing I want the IWM and some of the small caps is we have to understand why the Fed's cutting. If it's recession fears and we're seeing a big drop off, don't forget most of those small caps are very domestic in their exposure, and therefore
very cyclical.
Yeah, very, very cyclical, a lot of domestic exposure. So if the Fed aggressively, because of recession fears, there's some of the names that are going to be performing the worst when it comes to earnings. So I probably have a little bit more of a bond duration assets that Terry had mentioned more so. Another area where I'd be looking at would be something like the LQD, which would be an investment grade bonds, more safe haven plays in that scenario. I would small caps, at least in the initial take. And then once the smoke had cleared a little bit, then I think that would be a screaming buy on that. But you just want to be a little cognizant of why rates are getting cut. Is it just because inflation's cooled and they could be a little less restrictive? Or is there a big fear about an economic slowdown that would obviously impact a lot of those small caps a lot more?
So and to your point, right, there could be two very different versions of coming into this about the Fed. And one is everything's held together with the economy, and now they're past the election, they can be proactive. And while the economy is still holding up, they can get ahead of the curve with a big 50 basis point cut and signal another one coming in December. And they're making that adjustment proactively. Then I think you've got the base case for, the soft landing scenario can still find its way. And in that case, then I still have to take off. But the alternative is, it looks like waiting until November was waiting to see more indications that we could be headed for a hard landing. Then, Jay's right. That stuff's 10-foot pole.
Jay, the bond you mentioned is LQE?
LQD.
QD. Got it. Yeah.
Grade corporate bond ETF.
Oh,
and you can put that on a weekly chart, Sherry. You can see this getting ready to break out here.
Oh, okay. Got it.
There, you got any thoughts on that chart?
Yeah, I mean, the only reservation I have is if you're headed for a hard landing chain a bit, and you get treasuries taking off and you get spreads widening at the investment grade level, but it's not gonna fare anything like HY. But I would prefer TLT, I guess, in that scenario. But if we're talking about a sort of more moderate garden variety style kind of contraction, chart looks like a breakout. Sure.
In consolidating and yeah, looks like the.
I mean, that's rates. What you're seeing right there. It's the end of the 10-year yield effectively.
Yeah.
So as the Feding rates, if we don't see spreads widen too much at the investment grade level, then this thing takes off.
Yes.
You'd have to see Caterpillar getting concerned about its credit.
Okay, cool. I think we covered about like from last week's market volatility, VIX, yen carry trade, and also the outlook for Fed cut and earnings later. Yeah, it's a lot to watch. A lot of we will keep our updated. So thank you, Jerry, for the discussion, and we look forward to talk to you guys next week.
Yeah, thanks a lot, Sherry. And just as a heads up, a premium product, we're going to be putting out an article about that fund managers survey, as well as an article about the July earnings period. So I highly recommend everyone to check them out.
Yes.
Okay. Yep. And so much, Sherry. Thought this was a really good discussion.
Yeah. Thanks, Sherry. Thanks, Terry.
Yeah. Thank you, guys. See you next.
Take care.
All right.